Welcome to Corporate Finance, 4 Types of Firms. The 4 types of firms we're going to be discussing is the sole proprietorship, the partnership, the limited liability company, and the corporation. This diagram shows you the types of U.S. firms, and as you can see, sole proprietorships make up 72% as the percentages of business, but corporations make up 83% of the revenue. A sole proprietorship is a business that is owned and run by one person. Typically, it has few employees. It's quite easy to create, but there is no separation between the firm and the owner, so there is unlimited personal liability, and the proprietorship only lives as long as the life of the owner. A partnership is quite similar to a sole proprietorship, but there is more than one owner. All partners are personally liable for all of the firm's debts. A lender can require any partner to repay all of the firm's outstanding debt. The partnership ends with the death or withdrawal of any single partner. Now we move to limited partnerships, which have 2 types of owners, general partners and limited partners. General partners have the same rights and liabilities as partners in a regular partnership, and they run the day-to-day business. Limited partners have limited liability and cannot lose more than their initial investment, and typically do not have management authority and cannot legally be involved in management decisions. LLCs, or limited liability companies, all owners of the organization have limited liabilities, but they can also run the business. This is relatively new form of business in the United States, and one that is picking up steam. A corporation is a legal entity separate from its owners. A corporation has many of the legal powers individuals have, such as the ability to enter into contracts, own assets, and borrow money. The corporation is solely responsible for its own obligations. Its owners are not liable for the obligations of the corporation. Corporations must be formed legally. The corporation files a charter with the state in which it wishes to incorporate. The state then charters the corporation, formally giving it a consent to be incorporated. Due to its attractive legal environment for corporations, Delaware is the most popular choice of the state for incorporation. Ownership of a corporation is represented through shares of stocks. Ownership is either a shareholder, a stockholder, or an equity holder. All of the ownership is called equity, and there is no limit to the amount of shareholders and the amount of funds that the company can raise by selling stock. Typically, ownership is entitled to dividend payments. The tax implications of corporations is double taxation. That makes S corporations far more lucrative, where the firm's profits are not subject to corporate income tax, but instead they're allocated directly to the shareholders via a K-1 form.